All right. So in this section of chapter 6, we're going to be looking at the optimal risky portfolio with a risk-free asset. So what are we doing here? Well, in the previous section, if you remember, we're looking at opportunity versus opportunity sets. And before that, we were looking at the minimum variance portfolio. So the question you have to ask yourself, hey, we actually try to find a portfolio with the lowest risk. Okay, we found one. Here's the formula for the weights of their portfolio. So much invest in bonds, so much invest in stocks. Great. Then we use that insight to say, hey, are there any other portfolios? Let's see how they behave in terms of return on risk. So we just vary the weights between stocks and bonds and graph those portfolios to an investment opportunity set. And we sort of talk which portfolios are good, which portfolios are bad. And the good portfolios are in the efficient set, and the bad one are in the inefficient set. And then what happens is that we look at the effect of the correlation on the investment opportunity set, because we have two assets. So it matters to us, well, we're going to create portfolios out of those two assets. So what changes those portfolios? Well, the correlation does. The returns of the stocks and bonds, they also change the portfolios we're going to create out of the two. But the correlation allows us to actually create like the money-making machine. If the correlation is -1, the minimum variance portfolio out of the stocks and bonds actually lies on the y-axis, and that portfolio has a zero risk. So great. But the question is, hey, we're actually in this to make money. So how do we know if we make money? You can say, well, we want to have a portfolio with the highest return. Technically, if you go back, that's not that hard to find, because here we have the highest return. We just go further in the investment opportunity set. We basically put more and more money into the stocks by borrowing more and more money from the bonds. We're basically leveraging ourselves. We're borrowing money to invest more in the stocks. So technically, theoretically, you can actually have unlimited returns on the stocks. You just have to borrow unlimited amount of money, right? So that works. But in chapter 5, we saw something called the Sharpe ratio. And the thing is that, well, I like high return, but I would rather have high returns with low risk. Okay, so we have to look at the portfolio, the best portfolio, the portfolio that makes money for us in terms of return, but also risk. So in order to do that, we're going to have to use the Sharpe ratio. Okay, so the Sharpe ratio, that's where the optimal risky portfolio comes in. So the optimal risky portfolio right here is the highest Sharpe ratio, right? The highest Sharpe ratio, the best return for the amount of risk, the best bang for the buck, right? So that means that we're going to have to find out of all these portfolios right here, they're all on this line, on this curve, they're all combinations of stocks and bonds. We're going to have to find a particular point, a particular portfolio that has the highest Sharpe ratio. So, but for the Sharpe ratio, we need to do what? Here's the formula for the Sharpe ratio. So we have the return on the portfolio minus risk-free rate divided by standard deviation of the portfolio. So we know can change markers. So we know this, right? Because we can calculate that expected return on the portfolio, and we did right here in this particular column. we also have standard deviation of that portfolio as well, right? So we have this. But for the Sharpe ratio, we also need risk-free rate. So we are going to we're going to put a risk-free rate into our mean variance space. So we're going to go actually to the way we graph stuff in chapter 5. Remember the Cal line. So this is our risk-free rate, equals 3%. Okay. So we're basically combining what you saw in chapter 5 and what we're seeing right now in chapter 6 together. So we saw it just several slides ago. We saw the investment opportunity set that is made out of the combination of two risky assets. Look at this graph. Do you see risk-free rate anywhere? Do you see risk-free rate anywhere? No risk-free rate anywhere. Okay. Here's the first time we actually put in the risk-free rate. Why? Because now we want to know what portfolio on this investment opportunity set is the portfolio with the highest Sharpe ratio, best bang for the buck. So now we're going to have risk-free rate, and we have the investment opportunity set, that particular curve here, right? I'm actually drawing here the curve. Great. Now, how do we find a particular portfolio on that curve that has the highest Sharpe ratio? There are formulas for this, but I'm going to offer you a visual interpretation first. So remember the Cal line from chapter 5. What was the Cal line? The Cal line, just going to draw something here. One Cal line, second Cal line, third Cal line. And we always draw the Cal line for, say, some asset B. So asset A, asset B, and then maybe asset C. Okay, so all those Cal lines represent different portfolios made out of the mixture, a combination of risk-free rate and some portfolio C, risk-free rate and some portfolio B, risk rate and some portfolio A. Okay. In chapter 5, we never looked inside what was the A, B, and C. We just put the points there and say, hey, that's a portfolio with a particular return and whatnot. But now we can actually decompose that portfolio. So instead of just a point, we can create a combination of portfolios made out of the combination of the component assets. Okay. So what we can do here is that A, for instance, is made out of, say, oil plus gold, right? And I'm going to use a different. That A actually has embedded within it an investment opportunity set, IOS. I'm going to call it IOSA. So this, for instance, gold, and this is oil. Okay. Asset B, for instance, is made out of two other assets and also represents another IOSB, for instance. And it's made out of, I don't know, let's put it USA stocks and, say, emerging markets stocks, EM, emerging markets. So technically, we can draw an infinity of Cal through this point, right? But going back, any point on this particular investment opportunity set represents a portfolio made out of the emerging markets and the USA. Okay, I'm just dotting those dots. So that portfolio B that we actually crossing with our Cal line is just one of the portfolios on that particular investment opportunity set. Technically, what we can do is we can have another portfolio, B prime, for instance, that's going to have another combination of emerging markets and USA. So in this particular graph, we can draw pretty much any investment opportunity set and draw any cal that goes through that investment opportunity set, and an intersection of the cal line with an investment opportunity set of any of these assets, A, B, or C. C we haven't graphed, but to be the same graph as for A and B, right? So an intersection of the cal line with the investment opportunity set will represent the portfolio. Okay, so now. So we just take one investment opportunity set, a mixture of stocks and bonds, and now we draw a cal through that investment opportunity set. And remember that the cal line that we draw, right, for instance here, boom, that represents a portfolio. Probably not the best portfolio. Why? Because you remember that what is the slope of the cal line? Slope cal is expected return on portfolio minus RF divided by sigma P Sharpe ratio. So you really want to have a line that starts at the risk-free rate and crosses the investment opportunity set in a point where that line has the steepest slope, highest Sharpe ratio. So what about the slope of that line? That slope is not steep, right? I'm going to put the down arrow. That slope is not good. Let's draw another cal line. Right? Well, that slope is still kind of low, because we can draw another cal line and intersect the investment opportunity set in a different point. Here, for instance, that actually is steeper. Slope, okay. Is it the highest we can do? Well, actually not the highest. We can sort of pivot the line even like further up. It's still a straight line, even if I draw it, it looks a bit like curvy, but straight line is going to hit the investment opportunity set in this particular point. And can you, at that point, will represent a portfolio. We're going to call this portfolio optimal risky portfolio. So we're going to call it OR, optimal risky portfolio. So you tell me, hey, well, okay, you find a portfolio. Can you find another one? Well, I can say, I'm going to draw another cal line right here. But to draw a line, you need 2 points. Do we have points here? No, we don't have any points there. We need an intersection with something on the cal line to actually be able to draw the line. Otherwise, you just draw in rays into infinity, right? It's like, well, there's nothing there. So we need the steepest cal line, but that still touches the IO, investor opportunity set, IOS. All right. So, well, visually, we're going to start at the risk-free rate and sort of pivot the cal line in such a way that it has a steeper slope and still touches the investor opportunity set. So that portfolio is going to have a return of somewhere, so it's a standard deviation of somewhere like maybe 12%, and return maybe I don't know, 7.2%. And you say, well, dude, that's great visually. I mean, I get the idea, right? I get the idea, but probably want to like have the highest. I mean, I want to have the formula, right? So if you want to have the formula, well, here's the formula. So remember that in order to create a portfolio, what you need is the weights. That's what you're being asked. You want to create a portfolio, you need the weights. As we did with the minimum variance portfolio, we need WB and WS. And remember, because we have just two assets, WB plus WS equals 1. So as soon as we have one, we can find the other. Right, so for the CFA, you have to remember this formula. Usually it's always a part of the exam, so there's not much variation from one year to another. So how do you remember this formula? As with the minimum variance portfolio, you have the variance on the top, and check this, S, B. It's still opposites. Okay. Going back to our formula for the minimum variance. Remember, I have the formula here, right? Here we have S on the top, B on the bottom. S, B, right? Why I'm doing this is because you're going to have to remember all of this. You have to memorize a whole bunch of formulas. So the more tricks and tips I give you right now, the easier things will be in the future. And you multiply this by the premium, but for the opposite assets, it's going to be a risk premium. And then you're going to have the B S, right? The opposite. But here you're going to have S for the second risk premium. So the second risk premium is going to be the risk premium for S, for the stock. So basically, you're not gonna you multiply a risk premium for bonds by the variance for stocks, and then the next term is risk premium for stocks multiplied by the covariance. Okay, covariance. Remember that this term is covariance of RB and RS. Covariance and correlation, they always show up on the CFA exam. They always show up on pretty much the vast majority of the financial exams because this is the basic stuff. So that's how I remember that. Try to remember. And I know they're going to have a whole bunch of premiums, but remember what I told you about the pyramid thing. So let's do, change the colors. And I'm going to do green, right? So do we have the pyramid here as well? Yeah, actually, let's see. So, how do I know it's a pyramid? Because the terms are very similar, right? You have the term on the top is repeated at the bottom. So it's, again, a risk premium by the variance. And that risk premium for B, variance for S, plus another risk premium, but not for the bonds, but for the stocks. So you're going to have to switch. Risk premium, I'm going to put PR for premium, PR, S by the variance of B. So you can see that you always switch the signs. No, so not the signs, but sub-indices. You multiply the premiums by the other assets variance. And then you have this. They have the sum of risk premiums, and you kind of know that. Doesn't really. You remember this. Order doesn't matter because it's a sum, right? So you just remember that as a sum multiplied by the covariance. So you can see that there's an internal structure to this. How do we derive these formulas? It's basically stating an optimization problem and then doing something called first order conditions. And basically stating this in the form of the derivative and then equaling this derivative to 0 and then backing out the weights out of that formula. So technically, this is not so complicated, at least for the two assets. I'm not going to ask you to derive this because we're not showing this. In the CFA exam, you're not going to be asked to derive this either. The much more interesting case is when you have 3, 4, 5, 6 assets, and then you're going to have to use matrix algebra. So that's not anything you can do. It's not anything that you should do with a pen and paper because Dealing with matrices without a calculator is a big pain. In the rear. Okay, so that's how you remember this formula. Again, you have a formula sheet usually in my exams. I don't know if when you see this video it's in the rules, but if it is, then great. If it's not, then it's something that you'll have to remember. Okay. Once you put the numbers into the formula, you're going to calculate WB. How do you get the other weight? Well, very easy. Take 1 minus WB. Why? Because you have this formula. Remember, the weights, you only have 2 assets, so the weights have to sum to 1. Do they have to be positive again? They don't have to, right? One weight could be minus 2. The other one could be plus 3. So at the end, you would have 3 minus 2 equals 1. So that relation will still hold. You're short 200%, and invest 300% of your money into the other asset, right? And you still, when you sum them up, the weight's equal to 1. So this weights will provide a portfolio with the highest reward to risk or Sharpe ratio. And please remember that Sharpe ratio and reward to risk or reward to variability. You may see this term in the homeworks is the same thing. Same thing. Okay. All right. So once we do this, once we apply the formula, what do we get? We get the weights for the stock of 0.432 and the weight for the bonds of 0.568. So in this particular slide, we're going to have 2 graphs and 1 pie chart. Okay. So I'm going to start with this. Then this is the second step, and this is the third step. Okay. That's how we're going to look at the slide. So when we apply the formula, we just plug in the numbers here, expected returns, risk-free rates, variances, then covariances, right? What we get is the weights. And, well, you see it's 7.16. And actually, we're kind of close. I put 7.2 here on the top for the return, and I put about 12%, which is a bit slightly off because I was doing it visually. It seemed like 10.15 was a much better, like visual approximation, but we were definitely close. So, of course, with the formula, you get the exact numbers. All right, very good. So that's where we're gonna be. That's gonna be our optimal risky. Optimal risky portfolio. Usually you're going to call that portfolio O, optimal risky portfolio. So that portfolio will have about 43% in stocks, 56% in bonds. Great. Fantastic. So what's the next step? The next step is, hey, so let me tell you how this happens in reality. So there are different people doing this first step and different people that are doing the second step. The first step, that's portfolio optimization. You have maybe quants, maybe some CFAs doing this stuff. So they build portfolios for particular purposes. Mixing portfolios, say we're gonna just take only dividend stocks and we're gonna optimize Sharpe ratio only for 30, just from the universe of 30 stocks with the highest dividend yield. Or some other portfolio where we're going to look at the corporate governance. The best corporate governance, select 50 stocks out of that portfolio, create the best sort of the optimal risky portfolio out of 50 stocks with the highest governance. Or select the sort of the ethical portfolios, or like no guns, no drugs, no oil. And out of that portfolio, select optimal risky portfolio. So Those guys do a lot of optimization and portfolio analysis to create the optimal risky portfolio. Now they package those portfolios in an easy to understand sort of a strategy, or like packaged portfolios, and then those portfolios, well, somebody goes to financial advisors and presents those portfolios to them. And the financial advisors that don't really care about optimizing portfolios themselves, what they care about is actually creating the best strategy for their clients. And when they do that, they have to care about the client's risk aversion. Remember, we did that in chapter 5. So the financial advisors then will take the portfolio O, right? And they say, hey, well, my client is maybe, 38 years old, 40 years old. Maybe he's got 2 kids and a mortgage. So he doesn't really want to put all of his money into a risky portfolio that has this standard deviation, because that's probably too high for him, right? So they use the YPREF from chapter 5 to calculate where you want to be, how much you want to invest into risky portfolio. Remember, we did that formula for the YPREF. What's the formula? Take the return on the risky portfolio minus risk-free rate divided by what? By A multiplied by the variance of the risky portfolio. And A was risk aversion coefficient. All that from chapter 5. Firefighters. All right, so that's where you want to be. You want to be, that's where the client actually wants to be, somewhere here. So that YPREF actually tells, when you apply to the formula, or apply this formula to the client, like by taking his coefficient of risk aversion, that formula then gives, I'm just going to put equal sign here, and I'm going to do something like this, will give you that YPREF equals 55%. So 1 minus YPREF equals what? 45%. So this is right here in the pie chart, and the 45% is right here in the pie chart. So does your client want to be fully invested 100% into a risky portfolio? Probably not, because he is not okay with 10% standard deviation per year of the portfolio. That's too much for him. That means that there's about an average portfolio, has that standard deviation. But if you remember the rule from chapter 5 about plus minus 1 sigma, that gives you sort of a normal distribution when you play with a normal distribution one, you know that 67% of the time, the return on your portfolio will be between what? Between 7 plus 10, between 17, or 7 minus 10 will be minus 3%. So our client probably not okay with having those bounds for their portfolio, sort of different values year over year. So you know what? I was just gonna tighten the portfolio volatility, because I'm not okay with too much volatility. But that, of course, means that you're gonna have to decrease your return, right? Because whenever you go on the CAL line, you cannot decrease your volatility without decreasing your return. It's just simply impossible. So then, financial advisor creates this personalized portfolio for their client, and that portfolio has 45% in T-bills and 55% in the risky portfolio. So what does a client get at the end? The client gets at the end a portfolio. Here's the pie chart that has 23% overall in stocks. How do we know that? Well, 23% is equal to what? Is equal to 0.43. 2 multiplied by what? 0.55 equals 0.2376, right? How do we get 0.53? That's where it comes from, and this comes from here. So that way you can know, oh, overall in my portfolio, I have 23% in stocks, 45% in treasuries, risk-free. I know how much yield they're gonna give to me. Gonna give me 3%. Great, no risk, because maybe it's a 10-year treasury or maybe a 1-year treasury. At least for that 1 year, I'm set. I know how much treasuries will give me. And then the bonds. Okay, apologies for that. And then the bonds give you 31%. Where does the number come from? 0.568 multiplied by what? 0.55. That gives you 31. Should I put the 0 here? 31.24. Okay. So where the numbers come from. So we just basically create a portfolio, the best possible portfolio for our client. Well, how do we know it's the best possible portfolio? So first of all, let me change colors. This portfolio O is the best portfolio, actually the best risky portfolio with the highest Sharpe ratio. And from chapter 5, you know that you really want to mix when you draw your cal lines. I'm not going to draw a cal lines, I'm going to draw a simple cal. Here's risk-free rate. Where you want to be. You want to asset A, asset B, asset C. Here's a cal, here's a cal, here's a cal. Of course, you want to have the steepest cal, because that steepest cal is going to have the highest Sharpe ratio. So you really want to mix risk-free asset with the asset that allows you to create the to draw the steepest cal line. So you really want to mix your risk-free asset with asset A, right? Because then any combination on that cal line, right, for the same level of risk, it's going to have the highest return compared to the cal lines for B. Okay, we can put cal A, cal B, and cal C. You don't want to be anywhere on B, and B is not a smiley face. A is a smiley face. Why? Because you really want to be anywhere on the cal line, because anywhere on this line, on the top one, you're always better than anywhere in the bottom B or the bottom C lines, on the bottom C cals, B cals. So A cal is the best. So our portfolio then has the steepest cal line, high Sharpe ratio. Great, we're doing well. So not only that, but our portfolio also matches the risk aversion of our client in the best possible way. Because our prep dictates, hey, our client would not be happy with just risky portfolio in his, even if it's optimal, but he's just not okay with that level of risk. So what we do now, we reduce the level of risk, but we still stay on the same cal line. We just add more risk-free rate to our risk-free asset to our portfolio. So we still get the same bang for the buck. Anywhere here on that cal line, Sharpe ratios, anywhere on cal, Sharpe ratio is the same because it's a line, it has the same slope everywhere. And that's a smiley face. Again, why? Because then we can be anywhere on that cal line, still get the best bang for the buck, and we can find a portfolio that matches our risk aversion of our client's risk aversion. And that way, hey, we can tell our clients, hey, we got the best portfolio in terms of bang for the buck, and not only that, we got the best portfolio for you in terms of your risk preferences. Boom, give me your money, right? I mean, in terms of fees and commissions, but not just all your money, right? So that's by itself actually is a fascinating tool. So what we do here is basically two-step two-step thing. Okay. I'm just gonna go forward a bit. This is called a separation property. So our portfolio choice is separated into two tasks. So our first task is what the quants and CFAs do. Basically, we just optimize portfolios, find the best combination of assets that fits a particular objective, right? Best combination of risky assets. Then I'm gonna put here quants, CFAs, and then the personal choice is what the financial advisors do, FAs. So that's where we have the YPref, if you remember that, right? We just covered it in the previous slide. So that's basically a two-step property. First, determine the optimal risk portfolio, and then you can combine it in the proportion that you want with the risk-free rate to create a portfolio that matches personal risk aversion of your client. Boom, done. So that guy actually got a Nobel Prize for that. Right? Simple. Now let's go back a bit. Right. So what happens if we have not only bonds and stock, we're going to have several assets? So then we're going to have a efficient frontier of risky assets. So how does it look like? How does it look like? Let's go back to our just hold on a sec. I'm gonna have to recharge. Some technical difficulties. Right. Well, we're going to come back to that in a bit. What I want to show you is how does the efficient frontier and how does optimization work actually in practice? How do we create optimal risk portfolios and how do we draw efficient frontier for several assets? I mean, using real world data. So in that link, to match the windows, I'm going to have to resize my window. All right, so Portfolio Visualizer has a lot of different tools. There's just one of them. Let's select, let's look at different start years, end year. We're going to work with asset classes. We don't know what to actually do with tickers. You guys like tickers. All right, so let's put Tesla, right? Let's put SPY. Let's put GLD. I usually ask people to volunteer tickers, but I'm just going to AGG, the aggregate bond ETF, that is one of the most famous bond ETFs. And what else? Let's put what else is there? Maybe some broad market ETFs. All right, so let's see. So this is a strategy. We're not going to constrain it. Minimum weight, max weight. We're not going to do anything like constraint optimization. We're not going to use geometric mean, no group constraints, no robust optimization. We're not going to use the full blown period because Tesla had a pretty recent IPO, Netflix as well. But let's see what we're going to get. So this is a very weird efficient frontier, but yeah, because we are constrained by Tesla, so we have only 10 years. So until February 2020. So this is a FIN340. Looks a bit weird, but well, it is what it is. So we're gonna have Tesla here, very high volatility, also high return. Netflix, again, very high volatility. You can see their Sharpe ratios. Pretty good Sharpe ratio for Tesla. 0.9 good Sharpe ratio for Netflix, but super high volatility. Look at gold. The much lower volatility, but also much lower return. Sharpe ratio 0.089. Not good at all. Gold has not been performing well in the last 10 years. Look at the broad ETF, right? So you have high return, but also high standard deviation. But in terms of Sharpe ratio, it's 0.5 compared to 0.089. So IWM is actually a much better asset and that has high Sharpe ratio. Not as high as Tesla, for instance, but it has low standard deviation. Oh, good. So then we have AGG. AGG has a 1 Sharpe ratio. Lower than Tesla, better than Netflix. But still, I mean, so can you actually combine the two? Can you get the better portfolio? So here's our portfolio. The Sharpe ratio. Let's and try to zoom in. It's kind of hard to see which one's a tendency portfolio, but it's actually mentioned somewhere else. Hold on. Here's our tendency portfolio. It has a Sharpe ratio of 1.93. Has to be somewhere here. Just have some points, so it's hard to see. Expected volatility 3.35%. I think it's monthly. Got our monthly data. You can actually check that. Yeah, it has to be monthly because I have about 100 points. And so it's a monthly volatility of 3%, expect return of 7.9 per month. As far as, yeah, it's maybe it's annual, but it's we have to see how they do their reporting. The Sharpe ratio, though, is pretty much 2, right? So out of the combination of these assets, we can create an optimal risk portfolio that beats any one of these assets in terms of Sharpe ratio. So basically, our portfolio that is made out of pretty much all bonds, 81%, plus some Tesla, plus some SPY, right? Plus some Netflix. Here are the allocations: 3% Tesla, 14% the broad market, nothing in IWM, nothing here, nothing in gold, right? Or maybe very low allocation, pretty much 0. So that portfolio that we have here has 1.9 Sharpe ratio. That's optimal risky portfolio. So if a client comes to you and says, hey, I just want you to construct a portfolio that did the optimal risky portfolio that has Tesla, SPY, GLD is gold, bonds, Netflix, and the broad market. Well, you put in this in an algo, and that's what you get, right? This weight that you get to build a portfolio for a client. So the key here is that will that portfolio perform well in the next year, in the next 5 years? That's where the whole quantitative CFA thing comes into play, because there are several algorithms where you can plug in your views, your perspective on the assets using, for instance, valuation models, and the algo then will use that information to find the optimal risk portfolio, right? And there's several models, even in our book, that utilize that particular model. I think it's called Black Litterman, that uses the alpha, which you're going to see in a bit. Okay, so, but usually, even if this is enough for you to see the usefulness of this approach, you will have different assets right? You can combine them to build optimal risk portfolio, and boom, you have the highest Sharpe ratio. And then you take this portfolio and mix it with a risk-free rate with the treasuries, say 1 year T-bill or a note that expires, I don't know, in 2 years, according to your client's horizon, and by combining the risk-free asset with the optimal risk portfolio, boom, you have a portfolio that has the highest Sharpe ratio and matches the risk aversion of your client. Okay, so this portfolio visualizer actually quite a lot of funds in my classes have used it over the years. It all depends on what kind of deliverables I ask from you for your particular semester. But if you want to use that for your market simulation game, you're more than welcome to. Okay, that'd be an interesting idea.